Right now, somewhere high up in the stratosphere, there is a multi-million-dollar military drone that, well, it physically cannot stay in the air as long as the Defense Department needs it to.
Right. And the limitation there isn't the aerodynamics. It isn't the software either.
No, it's the battery. I mean, it is simply too heavy. And today, we are doing a deep dive into a company claiming they hold the exact engineering puzzle piece to fix that fundamental weight problem.
Yeah. But if you look at their stock chart, Wall Street is currently just tearing them to shreds.
It's wild. It is easily one of the most fascinating market disconnects we've seen all year.
Oh, absolutely. On one side of the equation, you have a stock that has absolutely plummeted. I mean, crashing nearly 62% from its recent high.
Which looks like an absolute disaster zone.
It really does. But then you look at the actual business metrics, the actual money coming in the door, and revenue is exploding. We are talking about nearly 175% year-over-year growth.
Which totally defies common sense. Usually when a stock falls out of the sky like that, it's because the underlying business is falling apart.
Exactly, like the product failed or the customers left.
Right. But here, the business seems to be hitting hyperspeed while the stock price is just in a free fall.
And when you see a divergence that massive, you are usually looking at one of two things.
Okay, what are they?
Well, either it is a terrifying value trap, what traders often call a falling knife, where things are going to get much worse before they get better.
Right, the trap.
Yeah. Or you are staring at a massive asymmetric opportunity where the market has completely mispriced the fundamental reality of the company.
Okay, let's unpack this because we need to figure out exactly what kind of situation we are dealing with today.
Definitely.
So we are looking at Amprius Technologies trading under the ticker AMPX. It's currently sitting right around $9.24 a share.
Yeah.
Are we catching a falling knife or are we looking at a serious 6 to 12 month play for your portfolio?
That is the big question.
But before we even touch the messy financial data or the stock chart, we have to understand what this company actually does to justify a market cap of over $1.3 billion.
Because if the product is just hype, I mean, none of the math matters.
Exactly. So what is the actual product here?
We really have to start with the physics.
Sure.
So Amprius's core intellectual property, which actually originated from research out of Stanford University, is centered around something called silicon nanowire anode battery technology.
Okay, silicon nanowire anode. That sounds incredibly impressive, but also like something heavily jargon-filled.
It is a bit of a mouthful, yeah.
Let's break down the actual mechanism there. What does that mean for the physical battery?
Well, to understand why it's a breakthrough, you kind of have to understand how standard batteries work. Like the lithium-ion batteries in your phone or electric vehicle today,
Okay.
they use graphite for their anode. You can think of graphite like a rigid concrete parking garage for lithium ions.
A parking garage.
Right. When you charge the battery, the lithium ions basically park in the garage. But a graphite parking garage takes up a lot of space and adds a lot of weight.
Right, which is why electric vehicles are incredibly heavy.
Precisely. Now, chemists have known for a long time that silicon is vastly superior to graphite.
In what way?
Well, if graphite is a rigid concrete garage, silicon is like a super sponge. It can hold up to 10 times more lithium ions.
Oh, wow. So why hasn't everyone just been using silicon this whole time?
Because of a massive physical problem.
Yeah.
Swelling.
Swelling.
Yeah. When that silicon sponge absorbs all those lithium ions, it expands dramatically, up to like 300%.
That sounds dangerous.
It is for the battery. In a traditional solid battery structure, that expansion causes the silicon to literally shatter and pulverize itself after just a few charge cycles.
So it basically destroys the battery from the inside out.
Exactly.
So like freezing a glass water bottle, the water expands, the glass can't handle the pressure, and it explodes.
That is a perfect analogy.
Yeah.
And that is exactly where Amprius's nanowire breakthrough comes in.
Okay, how does the nanowire fix it?
Instead of using solid chunks of silicon, they grow these microscopic, incredibly thin wires of silicon, nanowires.
Like hair.
Exactly like hair. And because they are hair-like structures with space between them, they have the physical room to expand and contract without shattering. They solve the swelling problem.
Okay, so the mechanism makes sense, but how does that translate into actual performance for the user?
It all comes down to energy density, which in the battery world is measured in watt-hours per kilogram.
Right, the power-to-weight ratio, basically.
Yep. Standard top-of-the-line lithium-ion batteries sit somewhere around, 250 to maybe 300 watt-hours per kilogram.
Okay.
Because of this silicon nanowire architecture, Amprius is hitting up to 500 watt-hours per kilogram.
Wait, really? Up to 500.
Yeah, it's a massive leap.
So it is nearly double the energy density. To put that in perspective for you, it is like putting a hyper-advanced fuel cell into your car that takes up the exact same physical space, weighs exactly the same, but lets you drive twice as far in a single charge.
Right, or your laptop lasting 2 days instead of 1 without getting any thicker or heavier.
That is wild.
But here is the critical context. While cars and consumer electronics are a massive market, they aren't actually where this technology becomes irreplaceable.
Where is it irreplaceable then?
Where 500 watt-hours per kilogram changes the world is in aerospace, unmanned aerial vehicles, and defense applications.
Because of the weight constraint.
Exactly. In an electric car, extra battery weight reduces efficiency, but, the car still rolls down the road.
Right. It just might be a bit sluggish.
Yeah. But in an aircraft or a satellite, weight is the absolute binding physical constraint. You simply cannot fly certain next-generation high-altitude drones with standard batteries.
Because the batteries themselves are too heavy for the aircraft to even generate lift.
Exactly. So Amprius's tech isn't just an incremental upgrade for those industries. It is a step change that unlocks entirely new hardware that was physically impossible to build before.
I mean, I love the tech, but I have to play devil's advocate here for a second.
Go for it.
I feel like every year we see a million miracle batteries hyped up in tech blogs, and they are always stuck in some university laboratory.
That is very true.
Right. They never actually make it to the production line. So does Amprius have a real defensible business moat, or is this just really cool lab science?
That is the most important distinction to make when evaluating hard tech. And yes, they have a massive defensive wall, and it's built on a few very practical pillars.
Okay, what's the first pillar?
First, the IP is heavily patented down to the structural and compositional level. You can't just copy the nanowire recipe.
Okay, so the legal moat is there.
Right. But the second, and arguably more important moat, is the process engineering.
Meaning the actual manufacturing.
Yes. Manufacturing silicon nanowires at commercial volumes is brutally difficult.
I can imagine.
It's not just about knowing the chemistry, it's about building the massive, highly specialized machines that can actually grow these nanowires consistently on an industrial scale.
So they aren't just in a lab anymore?
No, Amprius isn't just running lab experiments. They're actually doing this at scale at their facility in Fremont, California right now.
So they have actually figured out how to build the machine that builds the machine.
Exactly.
That is usually where startups completely fall apart.
And that leads right into their third pillar, which is customer lock-in.
How sticky are these customers?
Very. In the aerospace and defense sectors, you don't just, buy a battery off a website and throw it in a military drone.
I would hope not.
The qualification cycles for these defense contractors take 18 to 36 months of rigorous, exhaustive testing.
Wow. Up to 3 years just to get approved.
Yep. And Amprius is already integrated and qualified with key defense and aerospace primes.
And I imagine once you endure a 3-year military testing cycle to get your battery integrated into a weapon system, the switching costs are astronomically high.
Oh, absolutely.
Like, the defense contractor isn't going to rip your battery out to save a few pennies with a competitor if it means starting that whole 3-year testing cycle all over again.
Exactly. You are locked in.
Okay, so the technology actually works, the manufacturing moat is real, and the customers are sticky.
Which is a solid foundation.
It is, which means we need to address the financial paradox we mentioned at the start.
Right. The numbers.
Because a great product does not automatically equal a great business. If the technology is so world-changing, why is the company losing so much money?
It's a fair question.
We are looking at that staggering nearly 175% revenue growth over the trailing 12 months, which is amazing, but it is contrasted against a completely terrifying net margin of negative 44%.
It looks alarming, sure, especially if you view it through the lens of a software company where profit margins should be high from day one.
Right.
But if we connect this to the reality of industrial scaling, it makes perfect sense. Amprius is in a deliberate, pre-profit capacity build-out phase.
Meaning they are spending money to make money.
Exactly. They are not structurally unprofitable. They are heavily front-loading their capital expenditures to build out factories.
Right, but I hear pre-profit capacity build-out and my alarm bells immediately go off.
Why is that?
Because that is the exact phrase we heard from dozens of EV startups in 2021, right before they went completely bankrupt. Why is this any different?
The difference lies in the operating leverage, which you can actually see in their gross margins.
Okay, explain that.
So over the trailing 12 months, Their gross margin sits around 18%.
Which isn't huge.
No, but in heavy manufacturing, gross margin is incredibly sensitive to volume because of fixed costs.
Like the factory itself.
Right. Think about a massive factory. The cost to keep the lights on, run the machines, and pay the engineers is largely fixed regardless of output.
Right.
If you run that factory at 20% capacity, those fixed costs are divided across a really small number of batteries.
Making each battery incredibly expensive to produce.
Exactly. Your margins look terrible.
But if the revenue is growing at 175%, that means the volume is skyrocketing.
Precisely. When you scale that same factory up to 80% or 90% capacity, those exact same fixed costs are now spread over millions of units.
The cost to produce the next battery drops off a cliff.
You got it. That 18% gross margin isn't the ceiling of what this business can achieve. It is the absolute floor.
So as those revenues continue to explode, that operating leverage will mechanically kick in, and those margins should expand materially.
That is the expectation, yes.
But survival is the operative word here, you know? Building factories and scaling operations brings a literal mountain of cash.
It does.
So how do they fund this without completely destroying shareholder value? Because if they have to keep diluting the stock, like issuing millions of new shares every quarter just to keep the lights on, then our piece of the pie gets smaller and smaller.
Even if the company succeeds.
Exactly.
That is the single most critical question for any pre-profit growth company. And Amprius has a very strategic advantage here, which is non-dilutive government funding.
Okay, the government is paying for it.
In a way, yeah. They are heavily integrated into Department of Defense and Department of Energy programs.
Why is the government stepping in on this specific company?
Because the U.S. government increasingly views advanced domestic battery manufacturing not just as an economic goal, but as a matter of critical national security.
Ah, they don't want to rely on foreign supply chains.
Right. They do not want to rely on foreign supply chains for the batteries that power next-generation defense tech.
That makes a lot of sense.
So Amprius is securing significant grant matching from the DOE alongside massive strategic prepayments from their actual aerospace customers.
Wow, so they're basically getting paid to build the factory by the people who want to buy the batteries?
Exactly. They are funding their factory build-outs largely with government grants and customer cash, which dramatically reduces the need to dilute retail shareholders.
That is a massive relief for anyone looking at the long-term thesis here.
It really is.
But if the growth is real and the government is helping foot the bill, we absolutely have to look at the chart.
Let's do it.
Because the sheer violence of this stock's movement is jarring. We are talking about a drop of nearly 60% over the last 13 weeks alone.
It has been a rough quarter.
If things are so great, why is the market punishing them so severely right now?
The technical terrain here is definitely dramatic, and we need to map it out to understand the psychology at play.
Okay, lay it out for us.
So the stock is currently sitting at $9.24. That is down a painful 61.9% from its June 2026 high of $24.22.
A huge drop.
But, and this is crucial context that panic sellers usually miss, it is still up over 52% from its August 2025 low of $6.07.
So it had a massive meteoric rise over the last year and then a brutal, sharp correction.
Yep.
But the longer-term structural uptrend, like the foundation it built off that $6 low, is actually still intact.
Exactly. A nearly 60% haircut hurts. But in high beta growth stocks, it often represents a necessary reset of excessive speculative enthusiasm.
So it just got a little too hot too fast.
Pretty much. What we are seeing right now is the stock testing a major historical support zone right around that $9 level.
Okay.
And more importantly, we're seeing a very bullish technical signal mechanically emerging within this massive drawdown.
Okay, what's the signal?
Volume contraction.
Volume contraction.
Yeah. Right now, the trading volume on these down days has shrunk significantly. It's currently at just 0.68 times the 3-month average.
Okay, walk us through the mechanics of that. Why is lower trading volume a good thing when a stock is actively dropping?
Think about the psychology of selling. When a stock falls on massive, record-breaking volume, it means the sellers are aggressive, they're panicked, and they're desperate to get out at any price.
There's a flood of supply hitting the market.
Right. But when a stock drifts downward and the volume dries up, it means the selling pressure is physically exhausting itself.
The panic is over.
The people who wanted to panic sell have already sold. The supply of available shares at this price level is disappearing.
Oh, I see.
It is a classic textbook sign that a downtrend is running out of steam and a bottoming process is actually beginning.
And here's where it gets really interesting for you. While the retail crowd might be exhausted and selling out of fear, the institutional market data scanners are lighting up with something else entirely.
Oh yeah, the whale activity.
Exactly. On July 15th and July 17th of 2026, those scanners flagged major whale activity in the options and equity flows.
Which is huge.
Massive institutional participants are quietly positioning themselves in this stock right in the middle of this huge drawdown.
And that is the ultimate tell in market mechanics.
Yeah.
Institutional players, the smart money, they don't just log into an app and click buy.
No, they don't.
They use complex option strategies and massive block trades to accumulate a position over time.
So when you see a 62% drawdown, retail volume completely drying up, and institutional whales suddenly stepping in to accumulate shares, what does that tell you?
It tells you that highly sophisticated traders view this correction as fundamentally disconnected from reality. They are aggressively buying the dip.
Which brings us perfectly into the sentiment tug-of-war. We know the whales are buying. But what is the broader market narrative doing?
It's a bit mixed.
Because if you're trying to weigh this investment, the signals are wildly conflicting. Let's start with the bulls. It seems like Wall Street analysts are finally waking up to the story.
Very much so. We had a major catalyst on the sentiment front in early July 2026.
Right.
On July 10, Jones Trading initiated formal coverage of Amprius with a buy rating and a $30 price target.
A $30 target on a $9 stock?
Yes, that implies a roughly 225% upside from where it sits today.
That's massive.
And just a day prior to that, Jim Cramer highlighted it on his platform, calling it a good spec and throwing a $33 price target on it.
Which pushes closer to a 257% implied upside.
Exactly.
Okay, I have to step in and push back heavily here, though.
Okay, let's hear it.
Analyst targets implying 200% upside sound fantastic. Whales buying the dips sounds great.
Right.
But if the institutions and the analysts love this company so much, why are the company's own insiders running for the exits?
The insider selling.
Yeah, because the SEC filing data is pretty stark. Over the trailing 90 days, insider flow shows net sales of roughly 292,000 shares.
That's a lot of shares.
That is 12 sell transactions versus only 6 buy transactions. If the people who actually run the factory and know the technology best are selling, why on earth should we be buying?
That is exactly the right question to ask. And it is absolutely the most critical piece of bearish data you have to reconcile.
So how do you reconcile it?
Well, you have to read insider selling at a growth stage tech company with a bit of nuance. Yes, it's a cautionary signal, but you have to look at the human element.
The human element.
Remember that massive run-up we talked about? The stock went from $6 to $24.
Right.
A lot of these executives and early engineers receive the vast majority of their compensation in stock options.
Oh, right. It's like founding a restaurant. You might know your food is the best in the city, but if your shares finally vest after 10 years of eating ramen and grinding in the kitchen, you're going to sell some stock to pay the IRS and maybe finally buy a house.
Exactly.
It doesn't mean you think the kitchen is on fire.
That is a brilliant way to frame it. When a stock quadruples from its lows, insiders are going to take profits, diversify their personal portfolios, or simply sell to cover the massive tax bills that are triggered the moment their options vest.
Okay, so it's not a panic sell.
Usually not. And the fact that there were still 6 buy transactions during this period shows there is still conviction internally.
That's true.
But the real market dynamic to watch here is the institutional buyers stepping in right as those insiders step out.
What do you mean by that?
In market mechanics, this is known as the transfer from weak hands to strong hands.
Weak hands being the insider.
Yeah, only employees and executives taking profits to buy a house are the weak hands. They are selling for personal life reasons, not based on the company's future value.
Got it.
Multi-billion-dollar funds accumulating a massive position because they want to hold it for the next 5 years are the strong hands. They're establishing a floor on the price.
That makes a lot of sense. It completely changes how you view a sell order on an SEC filing.
It really does.
So, bringing this all together, what could actually make this thesis fail? What are the genuine existential threats to Amprius that we need to be watching out for?
The biggest internal risk goes back to that manufacturing leverage we discussed earlier.
The 18% margin?
Yes, that 18% gross margin simply has to scale as volume increases. But in hard tech, first mover advantage is fragile.
Always is.
If a competitor achieves commercial scale faster or figures out a drastically cheaper manufacturing method, Amprius's technological lead could evaporate overnight.
Right. In this space, resting on your laurels is A literal death sentence.
100%.
So what are the actual events we're waiting for on the horizon? What are the specific catalysts over the next 3 months that could either launch the stock toward that $30 target or completely sink it?
The first major fundamental hurdle is their Q2 2026 earnings report coming up in August.
Okay, what are we looking for there?
Wall Street is going to be hyper-focused on that 175% revenue growth rate. Does it hold up?
Let's hope so.
And more importantly, what are the actual utilization rates at that Fremont manufacturing facility? Is that gross margin ticking upward as they scale?
Because a strong quarter showing real operating leverage could immediately trigger a re-rating of the stock.
Exactly.
And what about the macro environment? Because a stock with a beta over 2 doesn't exist in a vacuum. It's going to swing with the market.
Absolutely. The broader economy is a massive factor, specifically the September Federal Reserve meeting.
Let's break down the mechanics of that for a second. Why does a pre-profit battery company care what the Fed does with interest rates?
It comes down to how Wall Street values growth. When a company isn't making a net profit today, its stock price is entirely based on the massive profits it expects to make 5 or 10 years down the line.
Right, you're buying the future.
But mathematically, future money is worth less than today's money. Wall Street uses interest rates to calculate exactly how much to penalize that future money. This is called the discount rate.
So when the Fed cuts rates, the penalty applied to that future money shrinks.
Exactly. Suddenly, all those expected future profits are mathematically worth a lot more in today's dollars, and the stock price has to adjust upward to reflect that.
And because Amprius is so volatile and growth-focused, it is highly sensitive to this rate-driven multiple expansion.
Extremely sensitive, yes.
And then, of course, there's the speculative rumor mill, which we always have to acknowledge.
Oh, the rumors are definitely swirling.
There is persistent, loud chatter in the industry about potential electric vehicle partnerships and rumors of a massive multi-year supply agreement with a major aerospace prime contractor.
Obviously, rumors are just rumors.
Right. But if a finalized contract with a massive defense prime officially drops, those $30 price targets won't seem so crazy anymore.
Not at all.
So if we pull all of this together, we've looked at the explosive top-line revenue growth, the physical reality of the nanowire technology, the technical volume exhaustion on the chart, the nuance of the insider selling, and the upcoming catalysts.
It's a lot to weigh.
It is. So delivering a final synthesis, what is the verdict?
Amprius gets a fundamentally bullish score of 7.5 out of 10.
A 7.5. That is a very solid vote of confidence, but clearly acknowledging the real execution risks.
Yeah, it is an incredibly asymmetric risk-reward play, but it is vital to understand the timeline here.
Which is?
This is a 6 to 12-month horizon. It is a fundamental position trade, not a swing trade you jump into, hoping to make a quick buck by Friday.
You have to be prepared to stomach the volatility.
Absolutely. And the downside risk is very real. If it breaks below that absolute technical floor of $6.07, the technical thesis is largely invalidated.
But if it holds above that, the fundamental technological moat is undeniably strong.
It really is.
So what does this all mean for you? If you're looking at your portfolio right now and seeing a 60% drop in a position, your pure human instinct is probably to panic.
Of course it is.
But blindly following a red stock chart or freaking out over a single metric like insider selling without understanding the context of tax vesting is a guaranteed recipe for getting shaken out of incredible opportunities.
Right?
Balancing that staggering 175% revenue growth against the reality of a pre-profit cash burn is exactly why independent critical thinking matters. You have to look at the underlying mechanics, you have to look at the whole board.
And I want to leave everyone with one final, broader thought to mull over, something that connects the deep technical specs we've discussed today to a much larger global geopolitical trend.
Okay, what is it?
We touched briefly earlier on high-altitude pseudo-satellites, or HAPS.
Yes. These are essentially the massive solar-powered drones that fly in the stratosphere for months at a time, acting like cell towers or persistent surveillance nodes, but at a tiny fraction of the cost of actually launching a satellite into space.
Right. And as we established, they can only exist if the batteries are light enough and powerful enough to keep them aloft overnight when the solar panels aren't working.
Because otherwise they just fall out of the sky.
Exactly. If Amprius's 500 watt-hour per kilogram battery tech is truly the missing physical puzzle piece that makes uninterrupted, months-long HAPS flights a reality for the military, it changes the conversation entirely.
How so?
Well, could we reach a point in the next few years where this company is viewed by the market less like a volatile high-risk battery manufacturer and more like an irreplaceable protected national security asset.
Now, that is a perspective that completely changes how you look at a $9 stock.
It really does.
Something to definitely keep on your radar, and we will certainly be watching this space closely.